All right, we're going to continue into another case study and talk about how one might utilize this in commercial properties, multifamily, just larger dollar amounts than you would, say, on a traditional just small buy and hold or fix and flip. So this person, and if you've seen some of the previous videos, this will make more sense. But this person had been funding premiums for X amount of time. They've been using the cash value throughout their life to make them money or save them money. And you'll see the cash value growth over here on the right-hand side that's been growing over time. So they've been borrowing out early on for smaller deals. Larger deals become available as they're funding it. And you'll see all the way down here, we've got over $500,000 built up in here. So we can really utilize this to turbocharge our strategies, perhaps in commercial space. So here's one perspective. So this is a person who they had a large commercial building and they were putting $400,000 a year into the mortgage payment. So $400,000 a year going into the mortgage payment. And as we've discussed in other videos, what's it look like if you change the flow of the money? And so instead, we start putting the $400,000 through a policy instead, and then we would borrow against the policy and pay the mortgage. Well, as you've seen in other examples, year one, you get the greatest loss of access, I would call it. So you can't quite get out what you're putting in year one, but then every year thereafter, that number is getting larger and larger. So in their case, they put 400 in, they can only get 260 out, which means that left them 140,000 short that year. So that means they needed to come up with $540,000 that first year just to close the gap. And so what they were doing was they were charging rents for $540,000 to be able to pay for that. And that closed the gap on it. Well, just by that little restructuring, they were able to accomplish this because they knew every single year that spread was going to get smaller and smaller thereafter. And just like you do with any real estate, you're thinking long range. You're not thinking about what's tomorrow's dollar really. Yes, it matters some, but properties like this, you're thinking what's happening a few years down the road, 10 years down the road, 15, 20, 30 years down the road. What's going on with it? Well, here's what those numbers look like inside of a policy. I'm really going to break this down just a little bit. You're going to see the gray number is the cumulative outlay that they're paying in premiums throughout their entire life. The purple number is the cumulative cash value that particular year. So the first 15 years, they're taking max loans from the policy and paying the mortgage. And then after the 15 years, it's a 15-year mortgage. After that, maybe a little bit sooner actually, they will have paid off the mortgage. And then they've got the policy loan to contend with. So just like other examples, there's a timeline with which we will adjust premiums. And so we'll reduce premiums down. So you're going to see here, we start reducing premiums from year 10 to 15. They only put $500,000 in, a little over $500,000 over a 5-year period. But the cash value from year 10 to 15 grew from 4.6 to 6.5. The next 5 years from 15 to 20, they put a little over $500,000 in premiums, but it grew from 6.5 to 9 million in cash value. Now that is a good growth on your money. And keep going forward. You see that number just keeps getting larger and larger and larger. Plus, we haven't even talked about the death benefit that comes along with it in that case. And so you can imagine this company, this entity, should something happen or everybody dies, right? So at some point, this death benefit will pay out. So you can imagine how much windfall this entity will have or this family will have at that point. Now, again, just a side note, let's say you borrowed $9 million out of the policy year 20 here, and something were to happen, you were to pass away with a $9 million outstanding loan. They're simply going to reduce the $9 million from the death benefit and pay the difference to the beneficiary. And you're going to see the cash value growth that happens in here. From 15 to 30 years, the cash value grew from 6.5 million to 15.7 million. And they Went from 4.5 in premiums, cumulative, all the way up to $6 million. Now, year 30, that's a $9.5 million spread, which is not income taxable because that money stays inside the policy. You will always borrow against the policy, and the IRS does not charge on loans. It's just a phenomenal way to really turbocharge your existing strategies.